Okay, hello class, it's Finance for Entrepreneurs. We are looking at Chapter 4. This is a problem we worked on in class that I told you I would videotape and post online. Okay, so I'll give a quick review on it. Went over this in class, but here, Chapter 4, it's a break-even analysis. EBITDA, okay, that is, we are looking to see at what point that hits zero. And as I said before, that's earnings before depreciation, amortization, and taxes. So basically we want to see what our revenue, at what point our revenue will cover all those expenses. So we can reset that equation to say 0 equals revenue minus VC, variable cost, minus the CFC, which is cash fixed cost and interest. So what we have to do is reorganize that mathematical equation to read revenue equals VC plus CFC. Okay, and that's just simply a matter of moving some of the variables to the left and some to the right. With revenue, we want to reclassify that and just call that survival revenue. Basically, the revenue point at which it covers all the VC and the fixed cost. Okay, so we can write that survival rate revenue equals VC plus CFC. And again, we want to reorganize that equation to read CFC equals survival minus variable cost. Okay, and in terms of the variable cost, we really want to look at a ratio. So for example, if we look at the ratio of variable cost to its revenue, you might see something very typical as 2/4, 4/8. Okay, so the cost over the sales. Both of these, of course, come to 50%. Here, again, the VC, we're going to reclassify that variable as VCRR. And that just simply stands for variable cost revenue ratio, okay, which on the previous page was 50%. Okay, so it's going to be some 40%, 50%, 60%, 65%, etc. So now we can take the equation, bring that over from the other page. CFC equals SR minus VC. Okay, so your fixed cost equal survival rate minus the variable cost. Okay, now we can do some factoring out of that equation, as you may remember from algebra, basically. CFC equals SR 1 minus the VCRR. Okay, so we're just simply plugging that in for the VC. And again, we can reorganize that equation to represent it this way. SR equals CFC in the numerator and 1 minus the VCRR. So 1 minus some ratio. That's going to give us 40%, 50%, 60%, somewhere along those lines. Okay, so now I gave you an actual example in class. Okay, these were the specs. These were essentially what you are projecting for your company. So you are projecting $1 million in revenue. Your cost of goods sold, okay, CGS is $650. Admin, marketing, depreciation, and interest expense. Okay, interest expense typically will come from your leasing or some financial expense that you owe a company. You borrowed something, you have a lease on some equipment, etc., and there's some interest expense. Okay. And we get also a tax of 33%, which actually is, we really don't need. Okay. So this whole problem basically is trying to come up what is the contribution margin. Okay, that's that term in managerial accounting that you may have recalled. Okay, so how much revenue are we making to cover all the expenses? Okay, so from the data I just gave you, our ratio is going to be 650, the cost of goods sold, over the revenue, projected revenue of 1 million. That leaves you a 65% ratio. Okay. Now remember, the fixed costs are 200, 180, and 20. 200, those are coming from admin, marketing, and interest. Remember, depreciation we do not include. That is a non-cash item. Okay, so 200,000, 180, 20,000, etc. comes to 400,000. So now we want to rewrite that. Survival revenue equals 400 over 1 minus 65%. And that gives us the survival revenue of 1,143,000. Okay. Now, like in a lot of accounting and finance problems, we want to find some mechanism of checking your answer to see if in fact it works. Okay, so we're going to plug that number back into the data, the projected data. So instead of the 1 million bucks, this is telling us we need 1.143. Okay, so if that's our survival revenue, we have a percentage, okay, of 65% cost of goods sold. That would come to negative 743, leaving the gross profit of 400. Okay, now we take away admin, marketing, interest. That brings us to zero. The EBITDA, earnings before depreciation, amortization, and taxes, is zero. Okay, so that is our break-even point. So if this is your company, your entrepreneurial company, you need to say, okay, I need to make at least 1.143 million in revenue to simply survive. Okay. And that's it. Thank you.